A very warm welcome from us to our webinar on crypto regulatory developments in the EU and the UK. My name is Verena Ritter-Döring. I am a regulatory partner in the Frankfurt office of Taylor Wessing. And I'm not alone today. I have with me my colleague Miroslav Đurić, who is also in Germany. He's our real expert on crypto regulation at Taylor Wessing, Germany. But we are also giving you an overview of the UK regime. And therefore, I have Charlotte Hill. She's my fellow partner, also regulatory, very experienced partner in the London office. And she brought Katie Fry-Paul, who is equally into this as Miroslav is. So I brought lots of experts for you, and I hope you will enjoy this. Before we start with the content, I would like to say a few organizational things in the beginning. You all can see we have on the right below there is a question tab. You can use this and type in questions you might have. So only we will see the questions, not the other participants. We will answer questions at the end of the session. That's the idea. If you have any IT difficulties, you can also put questions there. We have a marketing and IT team in the background who will take care of you if you should experience some difficulties. And this webinar is being recorded. And if you want to have the recording and also the presentation, feel free to reach out to us after the webinar and we'll send it to you. So, and now let's start. I will give you a very short introduction on the current state of the regulation of crypto assets in the EU. And then Miroslav will take over, and then our UK team will take over and explain everything from the UK perspective. So a brief overview. Can be quite short. There is no harmonized EU regulatory framework on crypto asset regulation in the EU, neither for issuers of crypto assets and also not for crypto asset service providers. It differs significantly in all EU member states. This is not good news for the EU single market. And from a practical perspective, every provider or issuer of crypto assets who wants to enter the European market needs to assess in each EU member state and in the EU how the regulatory framework looks like. This is quite burdensome. I think it will become better in the end. Miroslav and Katie will talk about this in a few minutes, but at the moment it is really not ideal. There is one little bit of harmonization for virtual asset service providers in the EU. So who are virtual asset service providers? Those are the custodian wallet providers and providers of crypto exchange services. And they are obliged entities under the 5th AML directive, but it is only from an AML and counter-terrorist finance perspective. So this is not, it is not much, it is a beginning. And obviously the European regulator thought AML is super important. And therefore we started there in the EU. So we have currently 3 models of crypto regulation in the EU. So there is the first very pragmatic view. It is an expansion of existing rules. So since we do not have a harmonization, some countries thought, okay, we'll just do our own thing. And not very surprisingly, Germany did exactly this. We just expanded the scope application of the existing financial regulatory regime and squeezed in the crypto assets and the crypto asset service providers to have them regulated as financial institutions. Then a second way is a dedicated framework. This is, for example, the case in Spain. This is kind of a light touch regulation, registration regime. It is, yes, they just did a little bit of regulation, quite light touch, because there will be harmonization in the end. But if you want to enter, for example, the Spanish market, you have to find out where to register, what to do, and also have to file lots of documents with the authorities. And then we have the wait-and-see approach, as it is done in Italy, or still in Italy. I heard that Italy is also thinking about doing a dedicated framework approach, but as for now, they just use what they have and wait for an harmonization on an EU level so far. And this is also done in Ireland, if I remember this correctly. So, and now I will give you also a little bit of more background how it is done in Germany. So in Germany, we decided to define a legal term. We defined crypto value. Crypto value has 4 features. It is not issued by a central bank or any public authority, so it is not money in the sense of a central bank currency. But it is accepted as a means of exchange of payments. It serves investment purposes, and it can be transferred, stored, and traded electronically. And if all of those 4 features can tick the box of your crypto asset, then it is a crypto value. And then in Germany, you are inside the regulatory framework. And then if you provide whatever investment brokering or proprietary dealing or principal brokering in relation to a crypto value, you trigger a license requirement. So it's quite easy to get there. And also we have a quite new licensed activity in Germany. So if you want to offer crypto custody business in Germany, you also need a very specific license for this. And as if this weren't bad enough for the German market, you actually, if you want to combine those regulated services, as many of the service providers in Germany in relation to crypto assets do, they need 2 or 3 licenses and basically also 2 companies, which is at the moment really burdensome, and we hope it will go away once we get a harmonized framework. Yeah, but BaFin, so our German regulator, will be your regulator for both kind of licenses. In this regard, so at least you have to deal only with one authority. So this is how we do it in Germany, and now I will give it to Miroslav. You're mute. You're still mute, Miroslav.
Yeah, sorry. So hello and welcome from my side as well. So we're going to start now by having a look at the regulatory developments at the EU level, and starting with the digital finance package of the European Commission, which is basically the first package of legislative measures presented in September 2020, with which the European Commission is planning to make rules in the European Union more digital friendly and more suitable for the digital reality that financial services sector in Europe is currently functioning in. As part of this digital finance package, the Commission has also proposed 2 regulations that aim to create some sort of regulatory certainty in the field of crypto assets and crypto trading. First, on the left-hand side, you can see the proposal for regulation on markets in crypto assets, so-called MiCAR. which aims to create a harmonized regulatory framework on issuers of crypto assets, as well as service providers such as crypto exchanges, wallet providers, and so on and so on. We're going to go into detail a bit later. And on the right-hand side, we can see a proposal for another regulation, the so-called regulation on Dlt Pilot Regime, which basically intends to create an EU-wide regulatory sandbox within which regulated entities shall be able to deploy DLT for the purposes of securities trading and securities settlement without necessary needing to operate in non-compliance with some existing rules that we're going to explain a bit later. So MiCAR, as just mentioned, aims to create a single regulatory framework for crypto assets, and only for those crypto assets that do not already qualify as regulated instruments under existing EU regulations. So financial instruments under MiFID II, structured deposits, e-money, payment instruments, and so on and so on. The definition of crypto assets in MiCAR, in the draft of MiCAR, is quite broad. And it is defined basically as any digital representation of value or right which may be transferred and stored electronically using DLT or similar technology. So basically, this broad definition captures various types of virtual currencies, payment, utility, and hybrid tokens. From today's point of view, after its adoption by the EU Parliament and the Council, MiCAR will start to apply after expiry of an 18-month transitional period, which is foreseen in the draft of the MiCAR. And just a few days ago, we got some very important news. The Council Presidency and the European Parliament have reached a provisional agreement on 30th of June on MiCAR. This compromise text is now to be adopted by both institutions in the coming probably months, because we are just before the summer break, and it's unlikely that the EU lawmakers will sit and agree on this in July or in August. And from today's point of view, if we take all of this into account, it's not expectable that MiCAR will start to apply before the end of next year or beginning of 2024. MiCAR contains a very comprehensive taxonomy of crypto assets by differentiating between three types of crypto assets. First, we have the two types of the so-called stablecoins, asset reference tokens and e-money tokens. Asset reference tokens are first crypto assets that purport to maintain a stable value by being linked to the value of several fiat currencies, one or several commodities, crypto assets, or just a combination or basket of such assets. With this category, the European Commission originally intended to target stable coins such as Facebook's Libra, later called Diem, now pretty much the failed project, and also some other stablecoins that basically whose value is linked to value of different types of underlyings. The second category are the e-money tokens, that are crypto assets that stabilize their value by being referenced to one particular fiat currency. So this could be, for instance, stablecoin euro, stablecoin US dollar, and so on and so on. And the third category is a very broad category, more or less a catch-all category, which aims to capture all types of crypto assets that do not fall under the definition of either e-money or asset reference tokens. In the original draft of MiCAR, utility tokens that are defined under MiCA, which are basically tokens that give you access to certain service or a good provided by the issuer, are also captured in this category. However, policy-making bodies have been calling for a change ever since, and we are expecting to see some changes in the final text of MiCAR, because if we follow the rules from the Payment Services Directive and other regulations in the European Union, as well as certain national frameworks, like for instance in Germany, pure utility tokens that work in a similar way like electronic vouchers are not supposed to be treated as a regulated instrument. On the right-hand side, we can see very clear what falls under MiCAR framework, what stays out. Asset referenced e-money tokens, utility tokens, and virtual currencies for now. And as mentioned before, other regulated assets such as e-money, as well as security tokens that qualify as financial instruments under MiFID II will remain outside the scope. Under MiCA, there are some very important requirements on the offering of crypto asset to the public. So first and foremost, issuers of regulated crypto assets will need to prepare a so-called white paper, which is an information document pretty much similar to the securities prospectus, however, not that comprehensive, that needs to contain certain information about the issuer, about the offer, about the rights attached to the crypto assets, underlying technology, as well as the document that also needs, in a similar way like securities prospectus, emphasize risks associated with the investment in crypto assets. Issuers will need to notify these white papers prior to their publication to the public with their national competent authorities at least 20 days prior to their publication. An official approval will not be taking place. So national competent authorities will not be approving white papers, but will have power to prevent them from being published where they don't meet statutory requirements under MiCA. In a similar way, like under prospectus regulations, there are certain exemptions from the obligation to prepare and publish white paper for offerings for qualified investors, offerings that are below the certain volume, as well as for offerings of crypto assets that are offered for free or automatically rewarded in the course of mining, for instance. On a further note, under MiCA, we also have some requirements on marketing documentation, civil liability, as well as very interesting right to withdraw, which MiCA provides for. First and foremost, marketing communications relating to an offer of crypto asset to the public will need to be identifiable as such, fair, clear, non-misleading, and consistent with the information presented in the white paper. MiCA also requires member states to hold issuers of crypto assets liable under applicable national law for information provided in the white paper, and any explicit exclusion of civil liability in the white paper or marketing documentation will automatically be deprived of any legal effect. Also, as just mentioned, MiCA provides for a very interesting right to withdraw. So in a similar way, like consumers when purchasing goods online, investors in crypto assets that purchase their crypto assets directly from the issuer or a person acting on their behalf will have a right to withdraw from the purchase agreement within 14 days without the need to provide any reasons or incur any costs in relation to that. Under MiCA, we also have some bespoke requirements and a bespoke regime for stablecoins, which have attracted interest of the public and the regulators, especially in the last few months in a major way, especially after the Terra Luna collapse. And as explained before, MiCA differentiates between these two types of stablecoins in relation to both of which different requirements will apply. In accordance with the draft, issuers of asset reference tokens can be credit institutions or legal entities incorporated in the EU that are authorized under MiCA to act as issuers of asset reference tokens, whereas issuers of e-money tokens can only be credit institutions or authorized e-money institutions. There are certain additional requirements that issuers of these stablecoins will need to fulfill. First and foremost, there are some very strict requirements on the maintenance and use of reserve assets. They will be allowed to invest these reserve assets only in highly liquid assets. They will also need to hold them in custody with regulated institutions such as investment firms, depositories, and so on and so on. They will also need to have a clear policy and clearly describe in the white paper the stabilization mechanism used for their stables, and also will need to include information about custody arrangements, information about the possible redemption right, and so on and so on. When it comes to claim against the issuer, against the reserve assets and the redemption rights, in the draft, it was originally foreseen that issuers of asset reference tokens will be able to grant their holders a claim against them, whereas issuers of e-money tokens were required to grant the and to redeem at any moment at pair value e-money tokens for fiat currencies for their holders. Now there are some newest developments that are just a few days old that we're going to just touch base later on. Therefore, I'm not going to go too much into detail here because these points are now subject to change. On the right-hand side, you can see that there are also some requirements and a special regime for significant stablecoins. EBA, European Banking Authority, will be able to qualify asset referenced or e-money tokens as significant ones, where they meet certain criteria that are focused on number of token holders, value or market capitalization, number and value of transaction, size of reserve assets, and so on and so on. In this case, where EBA qualifies stablecoin as a significant one, the issuer will be under supervision of the EBA. So EBA will, for the first time, have certain direct supervisory powers in relation to such entities. Under MiCAR, we also have a bespoke regime for providers of crypto asset-related services, and I'm just going to briefly cover this. We have a different services under MiCA, which go pretty much in the same direction as the regulated services under MiFID II. If you can see on the left-hand side, reception and transmission of orders, execution of orders, investment advice, and so on and so on. And these services are grouped into 3 categories in relation to each of which different capital requirements apply: 50, 125, and 150,000 euros. And on the right-hand side, we see some main regulatory requirements that prospective crypto asset service providers will need to comply with, also going pretty much in the same direction as requirements under MiFID II framework, organizational requirements, requirements on complaints handling, management of conflict of interest, outsourcing, as well as some additional requirements applying to custodians, entities engaging in placement of crypto assets, operation of trading venues, and so on and so on. What is important to mention is that under MiCAR, entities providing crypto asset-related services will need to incorporate it in the EU and will need to be authorized by the NCA in the member state of their incorporation. Once authorized, these entities will also be able to benefit from the so-called EU passport, so to provide services on a cross-border basis to customers across the EU after following quite known notification procedure that we already know from some other regulations in the EU. ESMA will maintain a register of all authorized crypto asset service providers, and it's also important to mention that regulated institutions, for instance, MiFID II firms, will also benefit from equivalence regime, so they will not need to obtain new authorizations for the provision of crypto asset-related services. They will just be able to use their existing licenses to do so under MiCAR. And as just mentioned before, on 30th of June, the EU lawmakers have reached a provisional agreement on MiCAR, and as many of you probably saw in the news, there are many rumors circulating what happened, what changes have been made, and so on and so on. So here, I just tried to outline the most important ones that we saw, which are still not officially published. So we cannot go too much into detail. But I will start first with the left-hand side with sustainability, very important part that was actually experiencing some changes in March this year when the European Parliament insisted on inclusion of certain requirements that will require issuers to include information about the consensus mechanism used for their crypto assets and related carbon footprint in the white paper. On the same note, MiCAR will also require crypto asset service providers to publish information related to environmental and climate-related impact of each crypto asset for which they offer services. The reason for this is very, very familiar probably to all of you. European Union is striving to become a global trendsetter in the sustainable finance regulation and is also not missing the opportunity to include these requirements in MiCAR also. Below, we can see some points on NFTs. For the time being, in accordance with the unofficial information that we saw, NFTs will remain outside of scope of MiCAR as long as they stay not fungible, which is very tricky part, actually, because Under MiCAR, in this case, not NFTs will be able to qualify as crypto assets anytime where they get fungibility. We also saw some points regarding the collections like Bored Ape and so on and so on. It's highly likely that these types of NFTs will be treated as fungible assets and thereby as regulated crypto assets under MiCAR, but this really remains to be seen once the official version of MiCAR is published. On the right-hand side, starting with the stable coins, as mentioned before, following the Terra Luna collapse, all regulators around the world have been trying to find a right approach to regulation of stablecoins, and the EU regulator has decided also to make rules probably a bit more strict by requiring all issuers to back their stablecoins with the reserve assets one by one, and the token holders must be granted all stablecoins with a direct claim against the issuer, which is a big change in comparison with the draft. One additional point is actually that most probably issuers of stablecoins under MiCAR will be prohibited from granting interest to token holders dependent on the length of time that they hold these stablecoins. This is going to be pretty big problem for the so-called staking industry where we have a single issuers, but as mentioned before, it remains to be seen how the things will unravel once the official text is published. In terms of supervision, ESMA is supposed to have certain coordinatory role in the supervision of certain CSPs. We'll also maintain a list of all non-compliant CSPs operating in the Union, and we'll also develop standards for sustainability disclosures for CSPs. Coming to the next topic, Dlt Pilot Regime. As mentioned before, alongside MiCAR, European Commission has also proposed another regulation which creates an EU-wide regulatory sandbox which enables deployment of DLT for securities trading and securities settlement purposes. This regulation was officially published last month on the 2nd of June and will start to apply as of 23rd of March 2023. With this regulation, EU lawmakers want to enable national competent authorities to grant targeted exemptions from provision of currently applicable financial regulations to regulated entities such as investment firms, securities settlement depositories, and so on, in order to be able to deploy DLT for securities trading and settlement purposes. This regulation defines DLT market infrastructure as any of the following three. So DLT MTF, DLT security settlement system, or DLT trading and settlement system. The last one is basically the DLT market infrastructure that combines services performed by an MTF and securities settlement system into one by being operated by an investment firm, market operator, or CSD. Under the pilot regime, there are going to be some exemptions. As mentioned before, NCAs will be able to exempt regulated entities such as MiFID II firms and CSDs from, first and foremost, book entry requirements under CSDR that should enable recording of financial instruments on DLT ledger. Also from transaction reporting requirements under Article 26 MiFIR that are not designed with DLT-based financial instruments in mind, which basically cannot function if you use DLT for transaction execution. Further requirements in mandatory cash settlement will also be waived in certain cases, which shall enable use of tokenized instruments such as settlement coins or e-money tokens for settlement purposes, as well as requirements on mandatory intermediation through investment firms, for instance, that shall grant a direct access to DLT-based venues to retail customers. On the left-hand side, we see that regime experience also has some limitations. So shares, debt securities, and units in collective investment undertakings will be able to be used by DLT-based market infrastructures only up to certain amounts. So as you can see, shares up to your 500 million, debt securities up to 1 billion, and units in collective investment undertakings up to market value of the assets under management of your 100 million. Under the Dlt Pilot Regime, regulated entities will need to first apply for exemptions. And for this purpose, they will need to comply with certain minimum requirements that are very specific for DLT. So they will need to establish certain IT and cyber arrangements related to the use of DLT, specific operational risk management procedures, enter into appropriate custodian arrangements with wallet providers, and so on for custody of DLT-based financial instruments, and so on. As you can see below, the process will look as follows. So prospective operators will apply with their local NCA. NCAs will have generally 90 days to decide, and in this process, ESMA will be able to issue a non-binding opinion on the application, and once the NCA reach their decision, they will be able to grant a permission for operation for up to 6 years, which can be withdrawn at any time where the operator does not comply with requirements under this regulation, and permission comes with the EU passport option. And coming to the last topic in this chapter, implementation of the FATF travel rule for crypto transaction is a very big topic in the last few years in almost every major jurisdictions, including the EU. In July 2021, as part of its AML package, the EU Commission has also proposed a regulation which shall repeal and recast the wire transfer regulation and the FATF travel rule for crypto transaction. This regulation was also generally agreed on between the EU lawmakers on 30th of June, so just a few days ago, and in accordance with this regulation, CSPs defined under MiCAR will need to comply with the new provisions of the amended wire transfer regulations by being required to collect and transmit information about the originator and beneficiary of all crypto asset transactions, which is very strange, because originally in the first draft threshold was stipulated. Now this is not longer the case. In the second line, you can see what will be the required data, which will need to be interchanged between CSPs. So originators, CSPs, will need to collect name and surname of the originator, address, as well as any other relevant information such as official personal document number, customer identification number, and so on, as well as the account number in case of crypto transaction, a public key. Beneficiary CSP, on the other hand, will need to collect information regarding the name and surname of the beneficiary, as well as beneficiary's account number. CSPs will need to verify transmitted information and will also need to establish certain internal monitoring systems, ensuring that all required information are being transferred in relation to each in-scope transfer. And last but not least, the topic on unhosted wallets. Very big topic in this area. Many have been asking questions whether unhosted wallets will be part of this regime or not. In a case where a customer sends or receives crypto assets in the amount of more than 1,000 euros to or from their own unhosted wallet, the CSP on the other end will need to verify whether the unhosted wallet is effectively owned or controlled by this customer. This will also apply in the case where the transfer is originated from a wallet held by a non-EU CSP. So without further ado, since we are quite tight on time, I'm going to hand over to my UK colleagues. Thank you very much.
Thanks very much, Miroslav and Verena, and good morning from the TW offices in London. We're really happy to be here to talk about the UK regulatory environment for crypto and how that's changing in the near future. So the position at the moment is that the UK does not currently have a bespoke regime which applies specifically to crypto assets. However, some types of crypto asset will have characteristics which bring them within the UK's existing regulatory perimeter. So that will be either under the Financial Services and Markets Act, or FSMA, the Payment Services Regulations, or the Electronic Money Regulations. And under FSMA, it's prohibited for a person to carry on a regulated activity in the UK or to purport to do so unless authorised or exempt. And this is known in the UK as the general prohibition. And As part of this, regulated activities are activities which are of a specified kind and carried on by way of business and relate to a specified investment. For example, things like shares, debt securities, or units in collective investment schemes. Back in 2019, the FCA published its guidance on crypto assets, in which it set out its view on tokens which fall within this existing perimeter and which they call quite unimaginatively regulated tokens, and also those which fall outside of the perimeter, so unregulated tokens. The FCA divides tokens into categories according to their characteristics, and their categories that they use are exchange tokens, utility tokens, and security tokens. So unregulated tokens include exchange tokens, which are either centralized or decentralized, but these are tokens which are primarily used as a means of exchange. So this would include cryptocurrencies such as Bitcoin. Unregulated tokens also include utility tokens, which are tokens which might provide consumer with access to a product, current or prospective product or service, and grant rights which are similar to prepayment vouchers. These are also considered to be unregulated tokens. In some situations, an unregulated token might be used to facilitate regulated payments, in which case the provider using the tokens in this way would need to consider whether the services fall within scope of the payment services regulations. However, this doesn't bring the token itself within the regulatory perimeter. And then we move on to regulated tokens. So these are security tokens, which provide rights and obligations which are like specified investments, including those which are financial instruments under MiFID II. So firms which carry on specified activities involving security tokens, so arranging for investments in security tokens, for example, would need to ensure that they're appropriately authorized under FISMA and that they're following the FCA's rules in relation to their activities. So tokens which have the characteristics of things like a share in a company, a debt security, or a unit in a collective investment scheme will be regulated under the FISMA regime. In January last year, Her Majesty's Treasury launched a consultation and call for evidence on this regulatory approach to crypto assets and stablecoins in particular. And back in April this year, in its response, the Treasury confirmed that stablecoins which reference fiat currencies, and in this case, this is either a single currency or a basket of currencies, will be specifically brought within the UK's payments regime through amendments to the payment services regulations and also to the electronic money regulations. And this means that firms which carry out activities such as issuing, creating or destroying tokens, value stabilization and reserve management, providing custody services for third parties, will all need to be authorized by the FCA under the payment services regulations or the electronic money regulations. In this response, the Treasury also confirmed that it plans to consult more widely on the regulatory approach to unregulated tokens, and that includes cryptocurrencies like Bitcoin. And we're expecting that this consultation will open later this year. We also have AML requirements which apply to certain crypto assets. So in the UK, under the Money Laundering, Terrorist Financing and Transfer of Funds, Information on the Payer Regulations 2017, although that's a bit long, so we generally refer to that as the MLRs or the Money Laundering Regulations, relevant persons who are acting in the course of business carried on by them in the UK are required to adhere to certain AML requirements. And these include carrying out customer due diligence, conducting a risk assessment, and putting in place other measures, such as policies and procedures and appointing a nominated officer. In addition, in-scope crypto asset businesses are required to register with the FCA for the purposes of AML CTF supervision. So which crypto asset firms are within the scope of the MLRs? Well, the answer is that it is most crypto asset businesses operating in the UK. For the purposes of the MLRs, a crypto asset is defined as a cryptographically secured digital representation of value or contractual rights that uses a form of DLT and can be transferred, stored, or traded electronically. And this definition is really broad and will include most tokens in practice, whether they're exchange, utility, or security tokens. And it should be noted that there is no exclusion where a token is non-fungible. So as a result of that, under certain circumstances, a non-fungible token or NFT would be considered a crypto asset for the purposes of the MLRs. Both crypto asset exchange providers and custodian wallet providers are relevant persons for the purposes of the MLRs. In this case, a custodian wallet provider is defined as a firm or sole practitioner who, by way of business, provides services to safeguard and administer crypto assets on behalf of its customers or private cryptographic keys on behalf of its customers. A crypto asset exchange provider is defined as a firm or sole practitioner who, by way of business, provides a service for exchanging or arranging or making arrangements with a view to the exchange of crypto assets for money, money for crypto assets, or one crypto asset for another. So this is really broad. The operator of a crypto ATM will also be a crypto asset exchange provider. The relevant sections of the MLRs which brought crypto asset businesses into scope came into force back in January 2020. And there was a requirement for crypto asset businesses who are already operating in the UK to register with the FCA by the 10th of January last year. Existing businesses which applied to the FCA for registration before the 16th of December 2020 were allowed to continue operating past this deadline, but this temporary registration regime has now closed. Well, I say closed, it is closed for most firms. As of 30th of June, there is only one firm left on the temporary list, and the FCA has said that the regime remained open for a small number of firms because they may be challenging the FCA's decision or winding down its crypto business or making amendments. Amendments to the MLRs are due to be in place in September 2022. So I mentioned about registration of crypto asset businesses, and firms which are within scope of the MLRs have to register with the FCA. As part of that registration, the FCA has a responsibility to determine whether a crypto asset business and any officer, manager, or beneficial owner of that business is fit and proper, i.e. whether it has adequate skills and experience and may be expected to act with probity. The FCA will assess all elements of the extensive registration application and conduct interviews with directors and the nominated officer. So in this respect, the FCA acts as a gatekeeper, and any crypto asset businesses which do not meet the relevant standards will be refused registration, and so will not be able to undertake crypto asset business in the UK. The proportion of firms succeeding in the registration process has been low, and the FCA has said that this is due to a great deal of firms not understanding or being prepared for the AML requirements. Once amendments to the MLRs take effect, the FCA will have the ability to publish its decisions not to register crypto asset firms, which it doesn't at the moment have the authority to do, although the FCA can already publish cancellation and suspension notices. Regarding changes in control, the FCA has the power to suspend or cancel the registration of a firm if it becomes aware that beneficial owners are not fit and proper. So, for example, if an acquisition has been made. This process, though, can take up to 90 days, and the Treasury identified a risk that illicit actors could acquire a registered crypto asset business and take advantage of this 90-day period within which the FCA's actions are limited. So when the amendments are made in September this year, a provision will be included such that potential acquirers of a registered crypto asset business will have to notify the FCA ahead of the acquisition. The FCA will then conduct an assessment of the beneficial owners and will be able to object to the acquisition, and they might even be able to cancel the registration of the crypto asset business being acquired. And these decisions will also be able to be published by the FCA. Amendments will also enable the FATF travel rule to be implemented in the UK. So in 2019, as mentioned before, FATF confirmed that crypto assets are within scope of the travel rule. The UK Treasury decided to delay UK implementation of this requirement in respect to crypto assets until such a time when compliance solutions were able to really facilitate adherence. But in its July 2021 consultation, the Treasury confirmed its intention to begin planning for this implementation through an amendment to the Mlrs. And in June this year, it was confirmed that the amendments to the Mlrs, which are being implemented in September 2022, will implement the travel rule. Now, in the UK, there will be a de minimis threshold of €1,000, which will not include any fiat transfer. It just refers to crypto assets. There will be a partial exemption for transfers which only involve UK-based crypto asset businesses, under which full information is not required to be sent with the transfer. But this full information will need to be required to a beneficiary on request. The initial consultation had unhosted wallet transfers being subject to the travel rule, but this has been taken out of the amendments. So for unhosted wallet transfers, businesses will only need to collect information for transactions which are identified as posing an elevated risk of illicit finance. So crypto asset businesses will have a 12-month grace period from the point at which the amendments to the Mlrs take effect in order to implement their compliance solutions. And they will be expected to have them implemented by the 1st of September 2023. So how can crypto asset businesses promote their activities to UK customers? Well, under FISMA, a person must not, in the course of business, communicate an invitation or inducement to engage in investment activity or make a financial promotion, unless the person is authorized or the content of the communication is approved by someone who is authorized, unless an exemption applies. And communications which are made from outside of the UK will be caught by this if the communication is capable of having an effect in the UK. And this is known as the restriction on financial promotion. In this case, engage in investment activity includes entering or offering to enter into an agreement which would result in a party to the agreement carrying out a controlled activity. Controlled activities and investments largely, but not entirely, correspond to specified activities and investments which mark an activity as being within the regulatory perimeter. So this restriction means that where an unauthorized person promotes a crypto asset, which is a security token which falls within the FISMA regime, i.e. is treated as a share or something like that, that person will need to, unless an exemption applies, have the promotion approved by a person who is authorized by the FCA. And the authorized person would need to confirm that the promotion complies with the FCA's requirements for financial promotions, including that the promotion is clear, fair, and not misleading. So in essence, the approver takes the regulatory risk for the promotion. But where a token is unregulated, the financial promotion restriction does not currently apply. Although crypto asset businesses should note that the UK's Advertising Standards Agency has recently published an enforcement notice which provides guidance on the advertising of cryptocurrencies and crypto exchanges which are aimed at UK investors. And this sets out various requirements which should be adhered to for such advertisements. For example, that they must include a warning that cryptocurrencies are unregulated. But this is something else which is also set to change, and certain qualifying crypto assets will be brought within the financial promotion restriction. So whilst the definition of qualifying crypto assets has not yet been confirmed, it's suggested that this will be broadly similar to the original consultation and will include any cryptographically secured digital representation of value or contractual rights, which is fungible and transferable. And there will be exclusions. So, for example, fungibility remains a component of the definition of the qualifying crypto assets. The government has not ruled out extending the regime further in the future to capture NFTs should it be necessary to protect consumers. There will also be a number of controlled activities which would trigger the financial promotion restriction. So in some instances, decentralized finance or DeFi protocols may be in scope of the extended regime, but this will ultimately depend upon the activities being carried out and promoted. So this means that businesses which are communicating with UK recipients or aiming communications at UK recipients will need to consider whether their communication falls within the definition of a financial promotion. And then also, if it is, whether it meets the requirements which are set out by the FCA. The UK government has also been investigating the potential uses of DLT in financial markets for some time, and this subject formed part of the consultation, which I mentioned earlier. The industry responses to that consultation identified a number of benefits which could arise out of the use of DLT in financial market infrastructures, but also some drawbacks such as greater fragmentation and implementation difficulties. In its response, the Treasury noted that current financial services regulation and legislation were drafted without DLT in mind, and that the government intends to support industry in ensuring that legislation and regulation can accommodate tokenization, for example, of securities, and DLT in financial market infrastructures. And in April 2021, the Chancellor of the Exchequer announced the development of a financial market infrastructure sandbox, which will support firms wishing to test new technologies and structures, and this will be up and running in 2023. Back in April this year, there was a flurry of announcements regarding the regulation of crypto assets in the UK. And John Glenn, who's Economic Secretary to the Treasury, gave a keynote speech setting out the government's plans to make the UK a world-leading regime for crypto asset businesses. And the Chancellor of the Exchequer declared his ambition to make the UK a global hub for crypto asset technology, as well as commissioning the Royal Mint to produce an NFT. The government wants the UK to be a global hub and the very best place in the world to start and scale cryptocurrencies, but this does not mean that the UK will lower regulatory standards when it comes to crypto asset businesses. The UK government's plan to support the development of this ecosystem will take into account the need for a dynamic way of regulating financial activities and products, which is tailored and proportionate, but also nimble and tech neutral. It will also take into account regulation, which will be shaped by the input and advice of industry, and also the importance of facilitating safe, sustainable, and rapid innovation. It was noted that English law and world-leading legal services and also English courts are a huge asset to this. The UK Law Commission, which has already published work on key subjects in the crypto space, is now being asked to consider the legal status of decentralized autonomous organizations, for example. And Mr. Glenn also spoke about the UK's track record of facilitating regulatory sandbox. He announced the FCA's crypto sprints, which took place in May and June this year. And these were focused on informing regulatory policy changes based on evolving technologies. And these considered the 3 problem statements, which are on the screen, which the FCA said cover some of the key life stages in the life cycle of crypto assets. The FCA published the outputs from its crypto sprints last week, and there were a number of points arising in each category, but also a number of cross-cutting themes. So, for example, participants suggested a principles-based approach to regulation to accommodate the pace of technology and market evolution. They also noted that ideally there would be an internationally accepted digital taxonomy, which would assist in developing a regime, and highlighted the need for this to be regularly updated to enable classification of crypto assets and application of rules. The FCA is reviewing the results of the crypto sprints and using them to inform policy thinking, but they've also set up further work streams to understand the connection between crypto and other areas like sustainability and operational resilience. So it's clear that this is a really exciting time for this area, and it's great that the UK government and the FCA in particular is listening to industry in this way. And there's no doubt that there is more to come in the coming months. And I think on that, if we have some time for some questions. Feel free to drop them into the questions box.
In the meantime, while we are waiting for some questions, I would maybe just use the opportunity to announce that we have been working for quite some time on one very comprehensive publication. Our UK team, as well as our colleagues from the United Arab Emirates, on the regulation of crypto assets in these 3 jurisdictions, which is going to be published soon. So provided that you have interest in the topic, just feel free to reach out and we'll be happy to circulate this. Because it analyzes very, very interestingly how the regulators in these 3 jurisdictions actually take very different approach to regulation of crypto assets.
The questions really seem to be about having the slides afterwards, and yes, certainly the slides and the recording will be available after this. So just to wrap up, I think we've had some really good presentations there, and really very thorough, and we've looked at really a good amount of the regulatory issues applying to the world of crypto. And I think what we've really seen from it is that the regulatory environment is really almost as dynamic and fast moving as the crypto sector itself. And certainly crypto is really a huge focus now for regulators globally. Crypto businesses are of their nature cross-border and international. So it's really important to understand the regulatory position in the bigger markets, of which the EU and the UK are just 2. Although, of course, with no harmonized regime across the EU, there is a need to assess the regime in each European jurisdiction. At Taylor Wessing, we've got a network of experts in different areas who all work together to advise all sorts of innovative fintech and crypto businesses on their regulatory obligations right across all jurisdictions. Indeed, the projects that we advise our clients on are all very much international in nature, requiring us to have knowledge of the requirements in jurisdictions globally and to liaise with experts in jurisdictions globally. We're really embedded in the crypto ecosystem, and we're also, interestingly, heavily involved in policy development, both UK and EU as well. Very happy to catch up. All our contact details are there on that slide. We'll be very happy to catch up and discuss crypto matters generally, or just have a chat about the world of crypto. So thank you very much for your attention. If you have any further questions, of course, other than availability of the slides, any of us would be very happy to take those. And if you send it to the wrong one of us, no problem there. We can always find the right home for it. So there's, as I say, our contact details are there. Thank you very much.